What's going on, everyone? We have a filing to talk about out of the ISC, and this is SR-ISC 2022-10, amend ISC options 4, section 5, series of options contracts open for trading. Now this was filed and is scheduled to be published on April 27th, which is tomorrow. And this is a proposed rule change, notice of filing. Notice this is not effective immediately, so this will take some time. Proposed rule change to amend ISC options 4, section 5, series of options contracts open for trading, which is what options 4, section 5 is. That section is series of options contracts open for trading. So a little background on this. In 2021, ISC amended options 4, section 5 to limit the intervals between strikes in equity options listed as part of the short-term options series program, excluding exchange-traded funds, shares, and ETNs, which stands for exchange-traded notes, that have an expiration date more than 21 days from the listing date, which was known as the strike interval proposal. The strike interval proposal adopted a new supplementary material 0.07 to options 4, section 5, which included a table that intended to specify the applicable strike intervals that would supersede supplementary material 0.03, section E4, for short-term option series and equity options, excluding exchange-traded fund shares and exchange-traded notes, which have an expiration date more than 21 days from the listing date. The strike interval proposal was designed to reduce the density of strike intervals that would be listed in later weeks within the short-term option series program by utilizing limitations for intervals between strikes, which have, again, an expiration date more than 21 days from the listing date. This is the table they're referring to here. You can see there's 3 tiers. It's all based on average daily volume that determines the limits for each particular ticker. Now, the changes they're making, again, the strike interval proposal was designed to reduce the density of strike intervals that would be listed in later weeks within the short-term option series by utilizing limitations for intervals between strikes which have an expiration date of that 21 days or more from the listing date. The exchange's proposal intends to continue to remove certain strike intervals where there exist clusters of strikes whose characteristics closely resemble one another, and therefore do not serve different trading needs, rendering these strikes less useful. Also, the strike interval proposal continues to reduce the number of strikes listed on ISC, allowing lead market makers and market makers to expend their capital in the options market in a more efficient manner, thereby improving overall market quality on ISC. Now, the exchange is reducing the number of strikes listed in a manner consistent with the intent of the strike interval proposal, which was to reduce strikes which were farther out in time. The result of this clarification is to select wider strike intervals for short-term option series in equity options which have an expiration date, again, 21 days from the listing date. Now, this rule change would harmonize strike intervals as between interweeklies, which are those having less than 21 days, and outer weeklies, those having more than 21 days, so that strike intervals are not widening as the listing date approaches. That is the whole reason why they're doing this. They're trying to prevent the intervals from widening as the listing date approaches for these options, and they're going to be basically harmonizing strike intervals between interweeklies, which is expiring less than 21 days, and outer weeklies, more than 21 days. As far as implementation, this will be implemented on August 1st, 2022. So there's a date for you. That's basically it. Just harmonizing some options.